Welcome to the InterMarket Analysis video update. This is a video that I do once a week, and I look at a number of different areas. The first area that I look at is the S&P 500 on a valuation basis. I look back at earnings reports that have already come out, and then we look forward to see what are the forecasts looking out into the future to see if the market is expensive, fairly priced, or cheap at any given time. Then I do a pretty extensive breakdown of growth versus value. And we want growth to outperform value when the market's positive. When the market becomes more defensive, value outperforms growth. Then I go through and I look at a number of different markets. We look at other indexes in the stock market, other sectors in the stock market. Then we look completely outside of the stock market at commodities just to see if there's any inflationary issues that we have to deal with there. And so, taking all of this together, we try to get some clues as to what's happening inside of the S&P 500. This is being prepared for Monday, December 23rd. Before I get into that, there's a thing called the SPXInvesting Program. It's free until the end of 2024. Feel free to check that out. There's a link that will take you to the website as well as to a video that talks more about the program. If you have any questions, you can send me an email at the address that's provided here. So feel free just to see if that's of any interest to you. Also, the intermarket analysis video that I'm doing right now, that's just one of the weekly videos that I do. All of the videos are meant to tie into the daily video. Okay, let's go back and look at the valuation of the S&P 500. This looks back on this chart, and we have a PE ratio of 10, 15, and 20. When we're above 20, we're considered to be expensive or overvalued. And we're well above this red dashed line, which is the PE ratio of 20. If price was at this line, then we would be considered to be at the top end of being fairly valued, but still expensive at that point. Now, we had a down week this past week, and so we've come down a little bit. And this area down below measures the distance from price to the PE ratio of 10. And it still shows that we're very, very overvalued. But we've been overvalued for a long time. This chart goes all the way back to 1980. And when we're above the red dashed line, we're considered to be expensive. And we spend a considerable amount of time in the overvalued part of the chart. Also, just to give you a reference point of some different events that have happened going back to 1980 and what the valuations were at that time. Then another modification of just looking at the straight PE ratio was developed by Robert Shiller, where he looks at a more smooth approach. He takes 10 years of earnings data to try to get rid of outliers and get a more average for what's actually happening on the earnings front, and then compares it to price. And he developed the Shiller PE ratio. As of Friday's close, it's coming in at 37.68. And that's well above the 10, 15, 20 level. Also, it's well above the median and the mean between 16 and 17. And you can see this chart going all the way back into the 1800s and what the valuations were at that time. So even according to this chart, we're considered to be expensive. Then the market looks forward, though, and this is a chart put out by Edward Yardeni, where we look at forward projections and forecasts. And I have a number of different indexes on here. This purplish line is the Mega Cap 8, and these are the ones that everybody talks about. They have the most impact on the indexes. And what is their forward-looking PE? Even though it's dropping a little bit, it's still coming in at 30.7, and that's well over that 10, 15, 20 level. Then we look down at the red line, which is the S&P 500, and even though it's been coming down, we're still above the 20 level, coming in at 21.6. Then we look at the mid caps and the small caps. They're closer to more fairly valued. They're coming in at 15.8 for the mid caps and 15.6 for the small caps. Then here's the growth versus value area where I first look at just growth all by itself. And even though we took a bit of a hit this past week, we're still in a pretty solid uptrend and we're coming back down to the 50-day moving average when you look at this all by itself. Where value's been kind of seeing some more weakness. Now it's still in an uptrend since the blue line's above the red line, but it's been really pulling back. Where we get some real insight with this is when we do ratios between growth and value, and we're getting a very high reading showing how growth is outperforming value. Just to give it a little different perspective, I look at an inverse of that same ratio, and this shows that value is underperforming growth. We look at some indexes, growth versus value, showing how growth is outperforming. Then here's an inverse showing how value is underperforming growth. And then we look at some ETFs showing how growth is outperforming value and how value is underperforming growth. So we're seeing a real consistent theme here. And we look at another index, a little shorter term time frame, also showing how growth is outperforming value. Then we look at a growth ETF and do a ratio with a value ETF and also getting a very high reading. So growth is holding up. Even with the weakness that we've seen, this is still under the surface of the S&P 500 and underneath the market, showing that, okay, there's some potential strength underneath. We're just going down right now as far as price, and we're still looking more negative when we do all of our analysis based on price. But at some point, this could really help prices go up. We just need them to start to go up. So we get confirmation from that. Then we look at another chart here of value versus growth, showing how value is underperforming. And then I break it out based on the small caps. And even though the small caps, you look at the index, we jetted up here in November and just been going down, down, down ever since. But if you look at the growth to value ratio, that's holding up quite well. And we're actually seeing a recent golden cross here with this ratio. That could be positive for the small caps. We're seeing that same thing here with mid cap growth to value. A recent golden cross, even though the index has been coming down. S&P growth to value in an uptrend and still holding up despite the weakness that we saw this past week. We want to keep an eye on inflation. This is a long-term chart. It's a monthly chart of the CRB index, which are commodities. And we're going up a little bit here, but still it's pretty much flat. So on a long-term basis, inflation doesn't seem to be a problem. Then we do another study down below, doing a ratio between the inflationary components of the CRB index and then the deflationary components of the CRB index. And this continues to drop off on a monthly chart. So we're actually going down as far as inflation when measured against the commodity index. Here's a daily chart of the CRB index, and over here are the different components that make up that index. And we're kind of going sideways right now, not really seeing any kind of an up or down trend. Overall, you could say that we're still in a basic uptrend, but really kind of chopping these days. Another inflation gauge that I follow is the Baltic Dry Index. And as a general rule, when this is going up, that's inflationary. Now it's going down, and so that would be more deflationary. Then what are the inflation expectations? This is an actual ETF that you can trade. The volume's not very high on this, but we're not really moving all that much. And this is a weekly chart. So we barely moved. We were down 0.25% from the previous week, according to this chart. So based on what we have from the market itself, inflation doesn't seem to really be a problem. Some other markets that we look at just to watch: aluminum, which is still in an uptrend, even though it's pulling back to its 200-day moving average. Corn is going up, it's still in a downtrend. Wheat is in a downtrend. And fertilizer going back up, but it hasn't gone above these previous prices that we've seen over the last 3 months. So that's not necessarily inflationary. And oil, which is actually going down, and you can watch this for a number of different reasons. I had been watching it for geopolitical reasons, not really moving all that much. So then we watch this to see if it's really going up. That could be inflationary. Now, if oil goes up because the oil companies are doing well and they're making more profits, that's positive, and stocks can go up as well. But if oil's going up for geopolitical reasons, that's a whole nother context. And so we keep an eye on this, and it's not really causing a problem at this time. We look at a gold to oil ratio, kind of chopping along sideways recently. And then we look at oil, which is the red dashed line here, which had been going up and now is pulling back slightly. And then we compare it with the 10-year yield. And then we look at the correlation, and actually the correlation is going down, and it's in danger of going into neutral territory. You can see over a period of time, these lines tend to go up and down generally in tandem with each other. Well, we've seen kind of a disconnect lately between them. Gas is in a downtrend. Diesel just kind of chopping along sideways recently, not really showing any inflationary fears there. Heating oil's in a downtrend, even though as I record this, it's the first day of winter. Natural gas is actually going back into an uptrend. Copper, this is what we use to look at the overall feeling of the economy going forward. And we're in a downtrend here, though. So this chart may suggest that some economic weakness still lies ahead. We look at a copper to gold ratio, showing how copper's underperforming gold, and they both have been not doing very well lately. Copper's been going down, gold's been going down, but still copper's been going down more. And then a longer term version of that same ratio, copper to gold. And then I also plot the 10-year yield and the 2-year yield here. And a lot of times they have a tendency to go in the same basic direction. And even though they're on different scales, they don't get all that far apart. We've seen a real disconnect going back to 2022, where interest rates have been going up as the copper to gold ratio has been going down. There could be some kind of a long-term change in the overall characteristic of the market. Gold is in an uptrend, but it's below its 50-day moving average. And silver is in an uptrend, but it's dealing with its 200-day moving average. Then I look at the closing price for gold on top and the closing price for silver in the middle, and there's a pretty strong correlation between the two. Now, it doesn't show that they're going up or down. It shows that they're going up or down together. Then we have a gold to silver ratio on top. When this is going up, gold's outperforming. When this is going down, silver's outperforming. And then we can compare it with the US dollar index, and there's a fairly high correlation between the top chart and the middle chart. And really what we're looking for are when they go in opposite directions, because most of the time they tend to go in the same overall direction. The dollar is in an uptrend now, and that's been pressuring stocks, even though it came down in Friday's session. Then we look at the euro on top of this chart and the dollar index down below. And then we also plot on this next chart the Japanese yen. So these are the three major currencies, the yen on top, the euro, and then the dollar. And we see how they interact with each other. And lately, the euro has now switched to a downtrend compared to the dollar, and they're getting pretty close to par. If we get down to about one here, that means the dollar and the euro are at the same level. And that could be a pretty good time to go on a vacation to Europe if you can afford it, if you can get there, because you get a pretty favorable exchange rate. We're also now in a downtrend with the Japanese yen to the dollar, and we're starting to see a death cross here where the British pound is now in a downtrend compared to the dollar. Then we look at some different indexes, and I do show this in the daily video. The bar chart is the regular S&P 500, which is a weighted index. So the big monster companies, the mega caps, they have more of an impact on the index itself. If they're up, the index is up. If they're down, the index is down. Well, to make it a little more fair, we have an equal weight version of the S&P 500. And as we were going sideways with the S&P, it was holding up. We were seeing the equal weight version really going down, and then everything went down this past week. We did see a bit of a bounce on Friday. So this still suggests that the bigger stocks are holding the market together. This is kind of that same thing, but a little bit reverse, where we look at the equal weight and compare it to the S&P. This has been going down, meaning the equal weight index is underperforming. We look at stocks, the S&P 500 versus the CRB index, which are commodities. And even though we've been pulling back, we're under the 50-day moving average. This is still in a longer-term uptrend. And we look at an inverse of that to see if we get any additional insight. We're coming above the 50-day moving average, but still in a downtrend, showing that commodities are underperforming. And this is a little shift that we're seeing right here, where the NASDAQ 100 is starting to outperform the S&P 500. It spent a lot of the later summer months and into the fall actually underperforming. Now it's starting to show some strength, and we're seeing a golden cross here with this ratio. And that could be positive for the market. When the NASDAQ 100 does well, that tends to help the S&P 500 because the stocks in the NASDAQ 100 are also in the S&P 500. The S&P 100 still holding up really well compared to the rest of the S&P 500, even with the down week that we saw. The NASDAQ, though, it's performing even better, and it's really outperforming the S&P 500. The NASDAQ 100, when compared to the NASDAQ, though, is still underperforming. So a lot of the strength that we're seeing right now, even though it's the bigger stocks that are holding up, the NASDAQ is actually outperforming. And then we look at the mega cap growth, the really big stocks, and compare it with the equal weight version of the S&P, showing that the mega caps are really outperforming here. Then we look at another ratio between the small caps and the S&P. That's the red line. And the small caps just, to this point, have not kicked into gear. They're supposed to enjoy what's called the January effect or the Santa Claus rally, whatever you want to call it. It just didn't happen, and small caps did not have a good week. The blue line on here is the S&P 500. And we look at a ratio between the small caps and the S&P 500, really underperforming. Mega cap growth all by itself coming down a bit now, but still well above its 50-day moving average and still in a really solid uptrend. The robotics and AI ETF coming back down more into the middle part of the rainbow, but really underperforming when we do a ratio with the tech sector. Dow Jones Composite Average, which is the Dow, the transports, and the utilities, seeing some weakness. Now, just a little over a week ago, the Dow set an all-time high. The transports were showing some improvement, and utilities, which had been stronger earlier on, are now starting to show more weakness. When you take those together, we're falling down below the 50-day moving average. And we look at a ratio between small caps and the tech sector, just chopping along sideways right now, but still barely in an uptrend here. And we look at the S&P and then compare it with other stocks. This is the advanced decline line studies where we're seeing some weakness here. Over the past week, we've dropped below the moving average with the NYSE common stock, S&P, mid caps, and small caps. We did bounce up a little bit in Friday's session, but we have a long ways to go to get back to the moving average. The Wilshire 5000 closed right at its 50-day moving average. Now, we're seeing some positive things under the surface, and please watch the daily videos for those. But right now, the market is not really proving that it wants to go higher. It just looks like it recovered a little bit of what was lost in Friday's session. The total U.S. stock ETF coming back down, fell below its 50-day moving average, and now coming back up to the 50-day moving average. Low volatility stocks, these tend to do really well when the market is getting more defensive. And they're in an uptrend, but they've fallen well below their 50-day moving average. However, they're still above their 200-day moving average. Where we see a real change is when we do a ratio between the low volatility ETF and the S&P 500, really underperforming. We were starting to see a golden cross here, but now this ratio has really fallen down, and we're starting to see a death cross with this ratio. We keep an eye on traditional Dow theory, which traditional Dow theory just looks at the Dow and the transports. And the Dow just setting a recent all-time high and then just not doing very well. Bounced a bit on Friday. The transports have also been weak, a little bit of a tick up here. The utilities, which had been really strong, seeing some weakness, they also bounced a bit in Friday's session. Transports, just not doing really well right now. And then we do a ratio between the transports and the S&P. And even though the S&P has been down, the transports are doing even worse. This ratio goes down. That means the transports are underperforming the S&P 500. Then we look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And even with the Dow being under pressure, transports are under even more pressure. So that's why we're seeing this ratio going up. Then we do another look at the S&P on top, the transports, and then the correlation between the two. And it's pretty strong right now. We've been going down with the S&P, down with the transports. So the correlation is fairly strong that way. Then we modify Dow theory. Instead of using the Dow, we say, okay, why not swap it out for the S&P 500? And then down below, instead of using the transports, why don't we use the NASDAQ? Seeing some weakness here after coming off recent all-time highs. Then we break that down even more. Instead of using the S&P 500 weighted index, why not use the equal weight version? That set a recent all-time high, but has been coming down. And then instead of using the NASDAQ, why not use the equal weight version of the NASDAQ 100, which is the QQQs, also under some weakness currently. The FANG index, which set an all-time high earlier in the week, it's been having some problems, but still well above its 50-day moving average and still in an uptrend. And these are a couple of trend lines I put on here, trying to match up these lows where we started to break above this shorter term trend line. Now we're back down below it as the market's seen some weakness. ARC is still in an uptrend, even though it pulled back with everything else this past week. And then we look at the all world ETF, but it takes out US stocks, really underperforming right now. You think things were bad this week in the US? They were even worse when we look across the world. Then we do a ratio between US stocks and our world stocks, and you can see this is really continuing to go up, meaning that the US stocks are holding up better. Then we look at a longer term chart here. This is monthly, and we look at US stocks and compare it with another global index with stocks in Europe, Australia, Asia, and the Far East. This continues to go up. Even when we have declines, US stocks are still holding up better, and the momentum is measured by the PPO continues to go up. And we keep an eye on bonds, and this is really going down. This is bonds based on price. What I focus on more is the yield of specifically the 10-year bond, and it's been going back up. The total bond ETF still in an uptrend, but coming down to its 200-day moving average. This has actually switched over to a downtrend. The Pring World Bond Index, we've seen enough of a drop where the blue line's crossing back down below the red line, or the 50-period moving average is crossing below the 200. But longer term, even though stocks have been under pressure, bond prices have been under pressure. So this continues to go up, meaning stocks are outperforming. Then here's a daily chart just to kind of confirm what we have already been seeing. This shows how bonds are underperforming stocks. High yield bonds, these are junk bonds, also seeing some recent weakness. And this tends to go more closely in hand with what the stock market is doing. Corporate bonds, which are still in an uptrend, but now coming back down to their 200-day moving average. And then we look at a ratio between junk bonds, riskier bonds, and more conservative bonds, government bonds. Folks are still preferring the riskier bonds. They're willing to assume the risk. They're not seeing a lot of risk with the companies that put out these bonds. They want the higher yield. And when this ratio is going up, that means they're willing to assume more risk to get a better yield. We look at a stock to bond correlation pretty strong now, meaning that if stocks are up, bonds are up. If stocks are down, bonds are down. Here's a daily chart of the yields where we were really coming down. And then right in here, this is where the Fed cut interest rates by 0.5%. And we started to go up. Completely the opposite of what you would think would happen. Then we finally started to roll over and the stock market was doing quite well. Well, now we're starting to go back up again, even though they ticked down a bit in Friday's session. Here's a weekly chart looking internationally with US, UK rates going up as well as German rates, where Japanese rates are pretty much going sideways to slightly down. Then we look at the volatility of bonds as measured by the MOVE index up on top. And then we look at the VIX, which is the volatility of stocks. And man, it really shot up this past week. We've now been starting to come back down and we're falling under 20, which is a critical level for the VIX. But the correlation between the two is pretty much neutral. And we look at the corporate bond index, seeing some weakness coming down below its 50-day moving average and could potentially come down to its 200-day moving average. This is corporate bonds based on price. And then this is not really relevant right now. These are some fib retracement levels on the 10-year yield. This suggests that we're getting into a higher range for the 10-year yield after we spent 40 years going down. And here's the same thing with the fib retracement levels with the 30-year yield. We're right in between any of these measurements right now. We look at another ratio between stocks and the 10-year yield. Well, stocks have been going down and the 10-year yield's been going up. And so we're seeing this ratio coming down, even though in the longer term, stocks are still in an uptrend compared to the 10-year yield. Then we look at this in a little different way. We look at the S&P 500 with short-term bonds, and yeah, coming down a little bit, but still in an uptrend. And we look at a broad market measure and then compare it with 3 to 7 year bonds, also seeing some recent weakness here. And then we look at another broad market measure in shorter term bonds, coming back down a little bit more into the rainbow. The tech sector versus 3 to 7 year bonds, coming down, but still at the high end of the rainbow. And then when this is going down the way it is now, that means bonds are underperforming stocks. And that's what we still continue to see. Junk bonds, which were doing quite well, also got hit a bit over the past week. And then we do a ratio between junk bonds, riskier bonds, and government bonds, and the junk bonds continue to outperform. Then here's a monthly chart of the price of the 30-year bond, which is now falling down below its moving average. And then on the bottom, we look at the long-term bond price and compare it with commodities, even with weakness. And even though we've seen for the last number of years a downtrend with the 30-year based on price, they're still outperforming commodities on this ratio. Then we look at some different sectors. The material sector's just getting hit, even though it's still in an uptrend. And then we do a ratio between the materials sector and the S&P 500, showing how it's really underperforming and in a downtrend. Communication, a growth area, been pulling back lately, but we're not even down to the 50-day moving average, at least yet. So when you compare it to the S&P, yeah, it's been coming down, but still it's in an uptrend, and this is one of the growth areas of the market. Energy was just getting hammered, even though it's still in an uptrend here as measured by the moving averages. But when we compare it to the S&P, really starting to underperform. Financials, which had been holding up quite well, but we started to come down. It looked like, okay, maybe some profit taking, but now we're just going down, down, down. Still below their 50-day moving average here, but still holding up okay, but seeing some weakness when compared to the S&P. Industrials also falling down below their 50-day moving average, and they're still in an uptrend, but lately they've been really underperforming the S&P. The tech sector, this is the real darling. We came back down and we're still at the 50-day moving average. That's still holding. And we're going sideways here, but we're in a downtrend when we compare tech to the S&P because both have been doing really well in 2024 if you remove what happened this last week. The staple sector is in an uptrend, but falling underneath its 50-day moving average. And also, we just seen a recent death cross with staples to the S&P. Now, this could be positive. When staples outperform, that means the market's getting more defensive. This going down, the market is more on offense or growth. Real estate just getting hammered and coming all the way down to its 200-day moving average, even though it's still in a longer-term uptrend. And we're really underperforming, and we're in danger of seeing a death cross here with the real estate to S&P ratio. Utilities, one of the stronger areas, pulling back below their 50-day moving average, but not down to their 200-day moving average, and still in an uptrend when compared to the S&P, but it's really been seeing some recent weakness. And then I look at this and I show it quite often, most of the time in the daily video. This is a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming. And even with the declines that we saw, the S&P has been holding up better than the utilities have, at least in this past week. Healthcare, a more defensive area, just coming down and seeing a death cross now here. Also really underperforming the S&P. Discretionary, this is Tesla, Amazon, things that make life fun. Really pulling back lately, but still in a longer term uptrend. This has been the best performing area since we had that real down move at the beginning of August. This has really been doing quite well. And it's also doing well when we do a ratio between discretionary and the S&P, even though it's pulled back lately. The energy sector is really underperforming the tech sector. And this is, I've been really hammering this in the daily videos. This is the semiconductor index, the SOX index. And when you look at this, we're in a downtrend. We've seen a recent death cross, and even with the bounces back up here, we have not been able to get back above the 200-day moving average. So you would be quite negative right now if you just looked at this. But if you look at the semiconductor ETF, we're still holding out above the 200-day moving average. And this is that same ETF, just showing that we've been chopping sideways. They were really outperforming earlier on and topped out over the summer. Since then, just not really doing all that well. It would really help the market if the semiconductors were to get some strength and really start to move to the upside. We look at growth stocks compared to more conservative bonds. Growth stocks are still outperforming. The tech sector compared to the 10-year yield, seeing some recent weakness here, but still tech is outperforming. Then here's an inverse showing how the 10-year yield's underperforming, even though the interest rates have been going back up. And that's why we're seeing this little spike here on the chart. Discretionary to staples. We want this to go up if we're more positive on the market. Discretionary is more growth oriented. Staples are more defensive. And so with this going up, that means discretionary is outperforming. And then this is just an inverse showing how staples are underperforming. Then we look at gold to the S&P, pretty much chopping sideways right now, not really showing any conviction there. And gold has been coming down and the dollar's been going up. And so that's why we're seeing this ratio drop recently. But as gold has been going up, that's when this ratio goes up. High leverage loans, even with the weakness that we've seen, we haven't even come back down to the 50-day moving average. NYSE composite, one of the stronger areas. This is a broad market measure, falling down below its 50-day moving average. All stocks, which looks at US as well as international stocks, doing really well in an uptrend, but falling down below its 50-day moving average. Emerging markets coming down to their 200-day moving average. We'll see if that can hold up. The Japanese Nikkei index just been jumbled around these high levels now for quite some time. The microcaps, smaller companies, coming back down a little bit below their 50-day moving average. We keep an eye on the home builders, not really seeing any divergences here. The S&P has been coming down, home builders have been coming down, and the correlation between how they're moving shows that they're going in the same direction at the same time. Bitcoin, which came all the way back down to its 50-day moving average after going above 100,000. We'll see if it can continue to bounce up from here. And we're in an uptrend in China. We're in an uptrend, but it could be weakening in the emerging markets. Also rolling over in Europe. Japan, look, is still in an uptrend, but could be rolling over, where we're starting to go down here in the US when we look at the S&P. The InterMarket Analysis chart has gold back in the lead year to date, and then the black line are stocks. The green, that's the dollar. The red line is oil, and we're still negative on bonds going back to the beginning of the year. We look at some correlations where the S&P and the dollar are going in opposite directions. When we get a really low reading, that's what that means. So if the dollar is up, stocks are down, and vice versa. We also look at the correlation between the S&P and oil. This is neutral right now. And then another correlation between the S&P and the 10-year yield going in opposite directions. And you can see that stocks have been coming down as this red dashed line has been going up. We need interest rates to start coming down for it to be more positive for stocks. Same thing we're seeing here. The tech sector to the 10-year yield going in opposite directions now. And then the S&P to the 2-year yield also going in opposite directions. Then some long-term charts. This is a monthly chart of the NYSE. Even though we're pulling back, we're still above this advancing moving average. And the Kopik curve, which is a momentum oscillator, continues to go up. This is the daily chart where we had been really going up with the NYSE record high percent index. Now it's rolling over just a bit there. And then this is a monthly chart of the S&P, still looking pretty solid here above an advancing moving average. Seeing a little bit of vulnerability here with the momentum oscillator that we use on this chart. And then we look at a daily chart of the S&P on top, and then a ratio between stocks and commodities, which is like very similar to what we saw earlier. Stocks are continuing to outperform. Then we look at a monthly chart here of stocks versus global stocks. And when this is going up, that means US stocks are outperforming, and we're still seeing another long-term oscillator, the KST, begin to go up. The blue line's going up as the red line's been flat. Then at the very end, I look at those things that are positive. My definition of positive as it applies to this video is when the 50-day moving average is above the 200-day moving average. So growth and value all by themselves are in uptrends. The dollar is in an uptrend. Gold and silver are in uptrends. The mega caps, the FANG index, those are the real mega cap stocks. ARK is still in an uptrend. The low volatility ETF, when you look at it alone, is just underperforming when you compare it to the S&P. Staples, another defensive area. The Dow Jones Composite average, and then the bonds based on price. The total bond ETF, the high yield, investment grade, corporate bonds, junk bonds. What's been taken off this list is the world bonds. The tech sector, high leverage loans are still looking good. The Dow, the NYSE Composite, and Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps based on the moving averages. All stocks are still in an uptrend. Emerging markets for right now are in an uptrend, and Bitcoin is in an uptrend. Then on the negative side, and we have a couple of new additions here. This is when the 50-day moving average is below the 200-day moving average. The CRB index, and it's kind of chopping around going sideways. Copper is now in a downtrend. That's a new addition to the list. And then I added the British pound and the yen to this list when compared to the dollar. And then when you look at the SOX index, it's negative. When you look at the semiconductor ETF, things are still holding up. And then the World Bond Index, that's another new addition as of this week. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.